All right, welcome back, everybody. Our YouTube fans, our YouTube audience, our Twitter audience, and of course, our supporters and Finom Group members. This week, we have the great pleasure of bringing to you more data, more technicals, a broad-based conversation on what the heck is going on between yields, rising rates, and tech stocks, or the NASDAQ as a whole. But this week, we also have a special guest in Chris Dover from Pollinate Trading. And he's going to tell us a little bit more about himself, about Pollinate Trading, about how to recognize, how to define regimes, and a couple of trades that he put on recently. So with that, again, welcome to this week's State of the Market. This is Finom Group. Let's kick things off with our usual quote of the week. The stock market is a giant distraction to the business of investing. Who said that? Jack Bogle, founder of Vanguard. Most of you familiar with Jack Bogle. You've either seen him on CNBC, you've heard of his really legendary and innovative way of creating funds that are no load bearing. And basically he says the stock market is a giant distraction to the business of investing. Market volatility, and this is basically what he's getting at. Market volatility can distract investors from their long-term goals. One of the most important takeaways from 2020 for long-term investors is this. It is important to have a plan in place before the storm clouds emerge and the market becomes a truly volatile place. Every day I run across investors, whether it's on Twitter, on StockTwits, on Facebook groups. I get emails at phenomgroup.com. I heard this, Seth. I heard that. I seen this. They send me links. And the reality is that what I extrapolate from these types of messages and communications is, what does it matter to you? Most of that stuff is just noise. If you have a game plan, if you have a process, you likely have repeatable profits over time. The rest of that other stuff is just a lot of noise, folks. So try to tune it out. Really great quote. Words to live by when it comes, especially from the king of ETFs, Jack Bogle. So with that said, here we are, year two, right? We're almost through the first quarter of 2021, folks. It seems like it's gone really fast here. We're technically in the second year of a new cyclical bull market within a longer term secular bull market. This chart right here from LPL Financial tells us year two of bull markets are usually strong. They might not be as strong as year one, but they are strong nonetheless. The previous 6 bull markets since World War II, they all saw gains during their second year. The average bull market was up 43% 1 year and up to 61% 2 years later. So just kind of compounding the gains from the first year into the second year. Here's a better picture, though, breaking it down instead of all these spaghetti lines here, which are all color-coded. And, of course, most of you already know, especially our Phenom Group members, I'm colorblind, so this really doesn't help me.
Me too.
You as well, Chris?
Yeah.
Oh, are you like blue-green, red-orange, or monochromacy like me?
Well, I mean, I know colors exist and I can kind of see that they're colorful, but I just don't know what they are.
Right. So you probably got monochromacy like me. I see everything pretty much in a shade of gray. When I was younger, I went to a special school, right? And I learned, the color prism based on shades, darker versus lighter. And to that extent, I also have to, colors have to be next to each other so I can actually distinguish lighter from darker. And that helps me if it's red or if it's yellow or if it's red or if it's green. But most of the time I just avoid colors and look at, numbers. Numbers are easier for me. And that's where this chart from Strategist basically outlines the same thing as this squiggly line chart. First year off the lows, there's your average. For the past new cyclical bull markets, usually the first year returns are about 42%, dating back to basically just the post-World War II era. And here's year two, the second year off of the low, the average return 12.7%. Now, we've already come off of 2 straight years, folks, where we've had double-digit returns in the S&P 500 as well as the NASDAQ. And we very rarely have 3 years in a row of double-digit returns. However, it happened more recently in 2012 to 2014. Can it happen again? Well, that's the point of the historic data. That's the point of the quants. And here it tells us, second year of a bull market, the average return is 12.7%. However, it's not in a straight line. Typically, the second year has a lot more volatility, right? Investors want to lock in profits. You have rising rates, especially if it's in accordance with a new economic expansion cycle. Knock on wood, I think that's what we're going through right now, and kind of contending and grappling with higher rates, higher yields. And that's why the average or I should say the max drawdown in year 2 off of the lows is 9.8%. Year to date, we've had 2 corrections here in the S&P 500. We had a NASDAQ correction of 12.5% on an intraday basis, a little more than 10% on a closing basis. But for the S&P 500, what have we done? We did a 4.5% correction from peak to trough to the end of January. And then we had, from the end of February going into early March, we had a 5.8% intraday, and a little bit more than a 4% on a closing basis. We've had 2 corrections with a 4% handle here already this year, which just speaks to kind of the volatility that you should anticipate, if not expect, in year 2 off of the lows of a bear market. Where are the fund flows going, folks? Well, they should be going to equities, and they are going to equities. That is also something that we tend to see off of a major low, especially if it's a crisis low. And I think 2020 qualified as a crisis low. So when we look at this chart right here, and this is Wells Fargo, yes, I have like 100 different subscriptions, people, so I get charts from everywhere. But this chart right here from Wells Fargo, going back to 2008, 2009 financial crisis, had accumulated $2.2 trillion in assets under management in money market funds. Look at it in 2020. We had actually been over $4 trillion for a goodly portion of time. And it's been coming down as that money has been moved off of the sidelines into equities. Don't get me wrong. Yes, there's always money moving into bonds, but a goodly portion has been moving into equities. This is also cyclical in nature. Fund flows are very cyclical in nature. We had 2 straight years of significant outflows in 18 and 19. Usually it's the 3rd year of a cycle that you see really strong inflows to equity markets. However, 2020 gave us an exogenous event, and we really didn't see that. We've seen it at the tail end of 2020, but there's still a ton of cash in the sidelines, i.e. money market funds. And you'll hear a lot about, well, money market funds don't necessarily translate into equity market flows. The reality is nothing's absolute. There is always a certain portion that will be put to work in the equity market. And we have seen very strong flows over the last month into equity ETFs. So good chart there. I love this. I picked this up, folks, from Twitter. I hang out on Twitter. You can find me on Twitter at SethCL. If I'm not causing trouble, you know, don't step in the middle of it. But this chart right here is really making the rounds because valuations, it's a bubble. Look at the valuation compared to the .com era right here. And that's what this particular Twitter account was saying. 20 years ago, the aggregate S&P 500 PE was a similar 24. Here it was at the .com boom/bust. Here it is today, right around 22. We've been hanging around 22.5 to 23.5 PE over the last 3-4 months. It's come back in a little bit recently. Also, keep in mind it's coming in because earnings estimates have been rising. But that looks ominous, right? That may, oh no, I don't want to be buying at the top of the market. And then he points out that the median stock traded at 14 times. Like this is the index PE. And then there's the median stock PE, which was much less back then at 14 times the index was at 24 times forward-looking earnings. Right now we have 22 times, but the median is trading at 21. Again, most of the times you see charts like this, it's trying to paint this bearish picture. It's trying to, sound the alarm bells. It's very sensationalistic. It's hyperbolic. But the reality is I look at it a different way and I say to myself, can we draw trend lines? Right? Can we draw trend lines, folks? And if I do draw my bottom trend line, what do we have? We have an upward sloping trend line support of PE expansion over time. One of the things that I consistently, talk about is the natural evolution or expansion of PEs over time, be it the CAPE ratio or others. PEs do expand over time. And so when I see something like this, I say to myself, where are my trend lines? What is this really telling me is that PEs in due deed expand over time. So my funny take on it, when I see charts like this, don't get all bent out of shape, folks. All right, well, we are here in monthly options expiration week. Monthly options expiration week, you tend to see a little bit of a pickup in volatility, kind of looking at where the greatest gamma exposure is coming into this monthly options expiration week, and quad witching coming tomorrow. You can see where most of the open interest is, 39.25, 39.75, and of course, the granddaddy of them all, and man alive, have they been trying to get it there, right? New all-time high. We've had 14 new all-time highs already here in 2021. More than likely, we're going to see more in the back half of the year. Let's not forget JP Morgan's Marko Kolanovic. What was his call? His call was for 4,000 in the first quarter. Dude's a beast. I mean, you had Bank of America, I forget, Michael Hartnett of Bank of America saying, sell the vaccine news. Going back to January, sell the vaccine news. Marko Kolanovic, 4,000 in the first quarter. So far, high of the year, 39.85. I'd say close enough, but we still have a shot at, of course, reaching that $4,000 level. Nonetheless, this is where the greatest gamma exposure is at this time. So just kind of a heads up, folks. Could we fall back down to 39.25? Absolutely. We could fall down to 3,900. Keep an open mind, have a game plan for either outcome. Statistically, this is just for your superfluous information. Much more than that, it's not actionable so far as I'm concerned. I execute my game plan. It's always good to have a game plan. All right, this chart right here, everybody says, well, the market's going up, but there's no volume. Good, good. Don't get excited, Chris. That's for me to do.
That's core. That's core right there.
Yeah,
you're nailing it.
People don't understand. They don't appreciate the fact there's the colloquialism, right, Chris? We've heard this time and time again. The market takes the stairs up and the elevator, if not the escalator, down. And there's a good reason for that. Buying is a process, right? Yeah, you have a game plan. You're waiting for your entry targets. You execute, and then you're on to the next. It's a process. Buying is a process. Processes are slower. The market goes down more rapidly. It takes the elevator down because there's a bigger fear component involved that drives volume. So we tend to have more volume when the market's going down. And that's what this chart basically outlines. It's from Thrasher Analytics. And you can see when we have big spikes in volume, when volume is elevating, well, the market's coming down. Volume is elevating, market's coming down. As the market starts to rally, you see volume come down, stagnate for longer periods of time. The 3-month average declining S&P 500 ratio is at one of the lowest levels in several years right now, folks. Again, this just speaks to there is buying, it's consistent, it's part of trend analysis, if you will. It speaks to the regime. For each dip that we've been getting, we continue to get bought back in pretty much an equal fashion and then some. It speaks to breadth, speaks to trend regimes, what investors are doing with pullbacks. This is a a 4-tier chart of our breadth indicators. All the advanced decline lines, the New York Stock Exchange is our top panel up here. The S&P 500 advanced decline line here. We got the small caps and we got the large caps. What do we see off to the right? All advanced decline lines are hitting new all-time highs. Typically, when you see that, well, when an index has an advanced decline line hitting the all-time high, breadth leads price. We're typically going to see new all-time highs at the index level in relatively short order. It can take weeks, it can take a month or so, but that's relatively short order. So breadth underneath the surface of price action has still remained relatively strong. Another way we can look at breadth and define that, although we see, setbacks in the market from time to time, the equal weight S&P 500 has been hitting new all-time highs. The relative performance of the equal weight S&P 500 versus the S&P 500, however, seems to be hitting a ceiling at this time. And we know that equal weight tends to outperform coming out of bear markets. It happened again, telling you that, yes, indeed, this is validation of a new cyclical bull market. But you might want to keep these levels in mind. We're hitting resistance. In the past, we had support. What was support is now resistance. Can we break through and go above? I leave that up to the market to decide. We'll find out. The market's going to give us more information as we go along. Financials, very similar situation. If you're in banks, if you're in big money center banks, regional banks, you're in the KBE index, you're in financials, the XLF, you know how well they've been performing. But just like the equal weight ratio to the S&P 500, this one is also hitting resistance. In the past, support, can you break through? Absolutely. Test above, retest, and off to the races. Support again, broke support, of course, last year, but here we are making our way all the way back to what is now resistance. We'll get more information in the coming days, weeks, months, and quarters. 5 trading days in a row. I think this has kind of gone under the radar because it started last Tuesday. We were up Tuesday, Wednesday, Thursday, Friday. We came into this week up on Monday. 5 trading days in a row, the S&P 500 was higher. We did this also in February. Most of you remember that. Here's a study from Quantifiable Analytics. After closing at a 50-day high, which of course we closed at an all-time high. So after closing at a 50-day high yesterday, and higher for at least 5 days in a row, as of Monday, the S&P 500 closed lower on Tuesday. Here, based on those those stats, if you will, here's what has happened throughout history after 5 trading days in a row, these qualifiers here. The next day, usually positive. The percent positive, 65% of the time. It wasn't in this case. We were down on Tuesday. But if we go out, the further in time we go out, 10 days later, 9 days later, 8 days later, after this qualifying aspect in the market, the percent positive rate goes higher, 70s, high 69s, and 80s. So this week has been choppy, but we've definitely closed higher several days after this particular signal, if you will, has taken place. So it's holding true once again, but we'll see how much strength this market has, and if it can get to 4,000, is that going to be the sell signal? Is that where everybody says, "All right, time to take profits and/or hedge"? Like I heard that at 3,000, then I heard it at 3,100. No, 3,500 is the ceiling. I meant 3,700. So that's just not the way that you really, in my opinion, should engage the market. Price is the least, consequential thing to me. Price doesn't change my game plan. That's my discipline. That's my process. I refer to my process, and my process says, keep buying. The conditions are there. Sentiment is there. The breadth is there. I look at all my, as a pilot, you have a checklist, right? Before you crank up the engine, a pilot has a checklist. That's his process. He's reviewing all of the different, gauges and whatnot that tell him, okay, I can crank up the engine. And then once he cranks up the engine, He's got a whole other checklist that he has to go through before he actually pushes the throttle. Same thing with me in the market. Know your process, refine your process. All right, this is the month of March, folks, 21 years. So this particular study comes to us via this Trader's Almanac. This goes back to 2000, the month of March. Typically, the month of March starts out okay, then we have a dip, but we really haven't dipped this particular go-round. We are in monthly options expiration week. We are at the end of the quarter. We'll see what happens, but so far, and let's face it, this year has not held true to the monthly calendar, the seasonality. January is supposed to be a good month. We were down in January. February, after coming off of a rough January and a 10% gain through the back half of the year, is actually supposed to be a profit-taking month when those particular signals. But we were up in January. So the seasonality hasn't really been there through the first part of the year. But I would be remiss if I didn't also remind us about the study. If you had a above average return year, the first quarter of the following year also historically delivers an above average return. So far, we have an above average return. The average first quarter delivers, and this is going all the way back to 1950, delivers about a 1.6% return. So from January through March, that's the average return. The above average return is about 2.5%. I think we're up, 5% or so already this year. So far, we're making it, but this market moves really fast. And we've seen, the S&P 500 drop 2.5% in one day. So let's not count our chickens before they hatch, so to speak. All right, this is the latest study that I found here from the Sentiment Trader. Third highest correlation in a decade between the VIX and the 10-year Treasury yield. And what we have seen is as Treasury yields on any particular day start to catch momentum, I think the biggest move in the VIX that we've had here in the month of March was on non-farm payroll day back in the first week. Well, we lost us for a second there, but we're back.
All right. There we are.
Okay. Sorry about that, folks. Technical difficulties, it happens. I'm in Florida. We have weather. We have a lot of tropical storms, even this time of year. But anyways, going back to this study here on the 10-year Treasury's correlation with the VIX. And it's at its highest level since basically, I guess you could say 2003, 2004. And we know what we owe this to. We owe this to the rapid or the rate of change in the 10-year Treasury yield. And you can see it in the NASDAQ VIX even more so than the S&P 500 VIX. But just like the chart is telling you, we've got yields up nicely today. And look at the VIX here today, folks. It's up a little more than 1%. We're actually, I think, hitting the lows of the trading session now. With the NASDAQ down 275, that tells me to go look at yields. Yields are actually not, they've been in this range here for the last couple of hours. So just some additional selling pressure. End of quarter rebalancing, possibly, name your crime. Attach your story to any, price action. And that's what we've seen over the last month or so when it comes to yields rising and the NASDAQ falling, the tech sector falling, fan mag stocks falling. There's this running narrative that it's all correlated to yields rising. I can't find it. I'm sorry, maybe I need a little bit more study, but I haven't been able to find it yet. What happened last week? Yields rose. I mean, we pretty much closed at the high 10-year yield of the week, and yet the NASDAQ was up 3% for the week. The tech sector was up. Equal weight tech was up. Most fan mag stocks were up last week. What happened Monday? Yields rose. Tech was up. The NASDAQ was up. I can go on and on. In terms of just the 10-year Treasury yield, what we're really seeing is just normalization. Back to an opening economy, a reopening cycle, back to a new expansion cycle. What used to be resistance is now getting back to support. We overshot to the downside here. 1.5% was kind of the baseline for, quite some time. You can overshoot to the downside before you stabilize and start, rising again there on the 10-year. And I think that's where we are in terms of overshooting to the upside, with the 10-year getting to 1.75% today, which is a post-pandemic high level. Some more correlations between, the 1-year correlation in the 10-year and real rates. Another chart here, good discussion on that. But here's where I'm not. This is really, in my opinion, and I'm not going to give any absolutes here, but in my opinion, there's not really this correlation when rates are going up, NASDAQ and or tech and or FanMag are going down. It's really about a hunt for yield, equity risk premium, if you will. This chart right here is the FanMag stocks, your Facebook, your Apple, your Amazon, your Microsoft, your Nvidia, your Google. And as you can see in the chart here, here's the trailing 12-month income before extraordinary items. Here's all your FanMag stocks going up. And here's your market cap weighting minus their earnings weight. The 6 FanMag stocks went from 14% of the S&P 500 earnings last year to 25%, nearly doubling their weight of earnings, which tells you it was priced in. FanMag did their job coming out of the bear market and pretty much through, I'd say, up to the fourth quarter of 2020. They had already priced in the recovery. They were a huge, cash flow generator. They were trusted. You trust tech cash flows. You trust their balance sheets. They had already priced it in. Their earnings growth, the FanMag earnings estimate growth for 2021 is 19%. But the S&P 500 earnings growth is supposed to be 44%. So where are you going to get the greatest yield? That's what investors are hunting for. Do I want to be getting 19% probability or 44%? Investors are hunting for the 44%, or the difference between the two, if you will. This is a hunt for yield. That is your job as an investor. You're hunting for where can I place my capital? Where is it going to achieve the greatest yield? After 2020, it's just not in FanMag anymore. Does that mean that FanMag is not going to perform? Does that mean that investors aren't going to buy Facebook, Apple, Nvidia, Microsoft, Amazon? No, but it may underperform the rest of the S&P 500 and or the NASDAQ. This chart right here, specifically correlating the Qs, the NASDAQ 100 with the 10-year yield. The top chart right here are the Qs. You can see the arrows show you what the Qs are doing. The bottom chart right here is the 10-year yield. Look at this. 10-year yield goes down. We chopped around here back in 2012. 10-year bottoms, starts trending higher. NASDAQ was trending higher already. 10-year yield goes down again. NASDAQ doesn't care. It keeps going higher. The Qs keep going higher. This was more of a correction back in the fourth quarter of 2018. Yields are going down. Everything was going down then. NASDAQ went higher into January of 2019 and just kept going higher, even as rates started going higher. Rates started coming down again into, I think that's, 2018, sorry, but it didn't matter. NASDAQ kept going higher, the Qs kept going higher. Here we are, big dip into 2020, from 2019 basically into 2020. Yields fell, it didn't matter. NASDAQ keeps going higher. So when yields are rising, so is the NASDAQ, so are the technology stocks, so are the Qs. When yields are falling, so are the Qs. The Qs are going up, the NASDAQ's going up. There's no real correlation. There's no if the Qs are going up while yields are coming down, it's not correlated. If yields are moving higher and the NASDAQ still moving higher, it's not correlation, it's coincidence. There's no causation here, there's coincidence. By the way, go look at the University of Michigan Consumer Sentiment Index. Chart it, put it up against the NASDAQ. It basically looks the same as the 10-year yield. So are we supposed to believe that the Qs are also correlated to the University of Michigan Consumer Sentiment? There's a difference between correlation, causation, and coincidence. You can see no matter what the 10-year yield is doing, over time, the NASDAQ is still going higher. We can further expound upon this then. What is actually happening? As I said before, it's a hunt for yield. What about the yield curve? Well, technically speaking, techs average to more positively sensitive to the yield curve. In fact, they performed. They're one of the 6 top performers. So of all the sectors, the 11 sectors in the S&P 500, it's number 6 when it comes to its positive sensitivity to the yield curve expanding. Say that 10 times fast, folks. Positive sensitivity. And last but not least, this is really where you can identify what's going on in the market, why tech, why FanMag is doing why large caps are doing what they are doing. Because whether we call it NASDAQ or tech, when we look at the S&P 500, I mean, you know, the S&P 500 is heavily loaded with the tech stocks. Their top 10 names are going to be your Microsoft, your Google, your Facebook, so on and so forth. So this chart right here, large cap growth equity series, earnings per share. I'll broaden this out. 50 trend line value, as you can see here, we have been the best. Tech growth was the best through 2020. It was the best. It doesn't have a lot of mean reversion to the upside to do. It's already been priced in. Trendline value for this particular large cap growth equity series going forward in 2021 is $56 a share, meaning that the mean reversion is actually to the downside. Now, if we look at value, large cap value, look how awfully it did in 2020. But look where the mean reversion gets you, $70 to $73. It has the greatest mean reversion potential in 2021. Why do you think value has been outperforming so well? It's all very logical, but the reality also, as I said, it doesn't matter what yields are doing, going up, going down, going up, going down. Look at the chart of the NASDAQ, look at the chart of the Qs. It still goes up. This really is not a matter of, you know, one day we have a surge in the 10-year yield and all of a sudden tech craters. Here's another chart I really love because this is from the Lighthold Group. You can see, initial glance, it looks scary because this was the dot-com era right here, and this is where we are right now. If you kind of step back for a second, you could say the same thing back here in the 1970s. This is the NASDAQ to the S&P 500 ratio, like the relative price performance between the NASDAQ and the S&P 500. This is the normal undulations. That's a $10 word right there, folks. Undulations. This is normal when you get to this level. And then it has a huge breakout. We did it again here in the 1990s and had a huge breakout. We're doing it again today, and we're getting this undulation right now. What is history basically tells us we should anticipate. There's no guarantees. We get it. We know that nothing's guaranteed. History doesn't always repeat, but it does one hell of a job of rhyming. Am I right? Okay, so if this holds true again, we should anticipate these undulations resolving with the NASDAQ outperforming the S&P 500 going forward. Do keep that in mind, folks. I was thinking about this the other day, Chris, because I watch these bond vigilantes. they propose themselves to be bond vigilantes and credit market, aficionados. And I'm listening to Jerome Powell at the FOMC press conference yesterday. I'm seeing all these tweets just left, right, front, and center from the popular Twitter accounts that follow, everything Burr and FOMC related, right? And I don't know why it popped into my head, but I was like, because somebody was telling me, well, it's not the 10-year yield that's causing it, it's the 5-year yield, because that's the break-even inflation rate. And I don't know why, but it all of a sudden triggered. What? Break even. And I automatically slashed it, because I'm always thinking in terms of relative performance and ratios. So when I heard break even, I had the semicolon, the colon there, and I'm thinking break even. Isn't that an oxymoron? They just don't work together. Break even. And I just said to myself, I kid you not. I tweeted this out. We will stop at nothing to bring efficacy, validity to the apparent scarcity of inflation, so much so that we've created an oxymoron to characterize it, i.e. break-even inflation rate. To me,
I call them the financial justice warriors. That's who they are. They would rather break everything so that they could be right.
Absolutely. Here's the last thing I want people to think about in terms of, we got the 10-year yield up to 1.75% today, this morning, little over 1.75%. And I'll make this my final word. On 3/5, right, when non-farm payrolls were reported, it shot up to 1.63%, and that was the high on the first week of March. Back then, the NASDAQ was 1,000 points below where it is today. So yet yields are now that much higher. So I'll leave it at that, folks. There's something else going on here. I'm not saying there's zero element of, because, the other argument is, well, tech stocks are duration assets. And man alive, do I ever want to get excited when I hear that? Because I think in terms of, in what world does a portfolio manager not have an investment time horizon of 3 years? How is that not a duration asset for all equities in anybody's portfolio? But, I don't want to get on my soapbox here today. So with that being said, as always, everybody, thank you for joining us on the State of the Market. I do want to now turn things over, again, introduce everybody to Chris Dover from Pollinate Trading. Chris and I are going to be partnering with Finom Group going forward and delivering lots of content. It really is about the analysis, trading process, identifying what's going on in the market. And Chris, I know you got your start back in the .com era. If you kind of want to, give our audience a little bit more about your investing philosophies, how you learn the art of the trade, so to speak, and some of the trades that you recently put on would be awesome.
Sure. Yeah. So I started April of 1999. I just got out of the Marine Corps and decided to hang out in California instead of returning back to the freezing cold Rocky Mountains. And I was lucky enough to be underqualified to get pretty much any job because I had no college degree. But luckily, the CEO of a prop trading firm was also a former Marine. Okay. He recognized my amazing abilities to follow directions without questioning things.
Always good attribute, right?
A great, especially when he's the former Marine himself, infantry Marine. Do that stupid thing. Roger that. Him being a CEO as well, he had a lot of people that he was a little frustrated that he couldn't get somebody to just step in and accomplish some menial tasks that were below people or whatever. That was my edge. Just, willingness to do whatever he asked. And in exchange, I was mentored. I got on a pretty good trading desk. The two top traders in the firm somehow, I guess, the ability to just do whatever I'm told led to a bidding war between the two of who I was going to work for. So it's a unique skill to have.
I've been told by my daughter I don't follow directions well sometimes. My 5-year-old daughter, by the way, because I forget her juice when I pick her up from kindergarten sometimes. And I kid you not, on several occasions, Daddy, you need to follow directions. So go ahead. Sorry.
She starts with, you did very good picking me up. Daddy, you need to follow directions. I'm still proud of you. The compliment sandwich.
There you go.
Puts her arm around you, like, let's go for a walk.
Yeah. Let me tell you about yourself.
And so, yeah, that was the height of the dot-com bubble there. I traded through that. Had a great mentor, taught me about systematic trading and just developing a system that is basically the term I've come up with is predictable and repeatable. It's predictable in the sense that you can predict that you have something to do, not predictable that it's the NASDAQ's going to 100,000 or any of that. Just predictable that you have to show up to work, because in 10 minutes, you're required to do your job effortlessly, just flawlessly. That's predictable. Here we go. There we go. Lost your screen. That's predictable. The repeatable part about it that's important is that if it's predictable and it repeats, that means you can pretty much do it over and over, right? Like if it only happens once every 10 years, that's not very useful unless you live to 1,000 years, right? But you want something that could repeat daily, weekly, in a manner that gives you statistical significance. And that's really what I was taught. I wasn't really taught how to look at indicators, how to do macroeconomics, how to do dollar cost DFAs, DCF. I wasn't taught how to analyze any of that sort of stuff. Just like, hey, it's kind of pattern recognition, really. Right. This is what happens here. Try to get it to happen. Try to find places where it happens more and more. Keep stats. Figure out where you have an edge. And now I'm, early 20-year-old guy. By
the way, everybody, I was same age as Chris. We're very close. Yeah.
We are. I got almost a 1-year-old, not a 5-year-old. So I got some learning to do from you. And so, like most people, you start out in the market prudent and brought under somebody's wings, and then CNBC convinces you that the tenure is the most important thing, or some stupid event that really you just hear it and it rhymes. So if it rhymes, that obviously means something, because why would something not be true if it didn't rhyme, right? Or some folksy old, guy who's been in the market for 185 years says something that sounds really good to you, and you're like, oh yeah, that sounds great. I think I should. So I kind of went down those rabbit holes of, like all the different things.
Yeah, exactly.
Yeah. And I mean, it took me about 7 or 8 years to pull my skills together. And actually it was, I ended up in Iraq in security for a number of years. And prior to that, I had spent a lot of time in technology too. So I get to the place, and there's rockets that happen in this country often. And I'm still trading. So I basically figured, I thought to myself, I was like, I should have all this stuff on a server in Chicago next to the CME, not here in Iraq on a slow connection. So, okay, let me get a remote system. And I was like, okay. And I also spent the last few years coding and data and all that sort of stuff. Let me just code up an algorithm. Not that super easy, but it wasn't hard. If this happens, and do that. Kind of code it up. And that was like the beginning of the systematic trading. Not really, don't really think high frequency trading or any of that sort of, just, it was a system. And that's kind of where I started down that path. And then fast forward a few years later, as we're getting into 2007 timeframe or so, I started, I realized that I was always just kind of jumping around at things, and I needed to quantify things. And so I took on the practice of manually backtesting strategies every day for an hour a day. And I've been doing that since 2007 or so. So that's 15 years or so. I've collected millions and millions of trades now in my spreadsheets. If you do 1 hour of manual backtesting after, practicing it a couple of times, usually it's about 10 trades you get done. Once you've done it, for 15 years, it's actually like I can do 30 to 50 trades in an hour, just because I've practiced. Nothing fancy about me. And so 30 to 50 trades is a lot of people's months or years. And if you're doing that 300, let's call it 300 days a year, well, that could be 300 years of practice that you've put in. And nobody really has done, not many people really do that. So what's key about it is suddenly you have predictable, repeatable trades, and you're less concerned about what the outcome is, because you know that the outcome is two things. It's either going to win this much or it's going to lose this much.
Right.
And it may take this long, a period of time. That's really all it is. And then you're just matching all that up. So that's really my philosophy generally, is like, okay, let's find the statistical edge here and let's apply it.
Extrapolate the emotions, and it's you're working off data.
Just simple. And this is me manually entering the trade. There's no algos doing it for me. I just have a spreadsheet there that tells me what is an outcome. And the real key to that finding the patterns is really good. But eventually you discover that you have a strategy that works, 80% win rate during periods, and then a 20% or a 10% win rate during other periods. That's where you get to that level. You're like, okay, there's something else in here that I need to figure out. And
educational process, when you get that much more, embedded into any process, it's like, okay, the next leg of this is, statistically understanding where my least profitable trades are coming from and where my most profitable trades are coming from, and focusing on, refining all that. Yeah. Get it. I get it.
Yeah. So there's this, so we've all heard of Einstein's theory of relativity, right? Where, and I'm not going to do science class here, or physics class, but the general idea is that if you're standing still, the person who's jogging past you is moving fairly fast. Mm-hmm. The person who's jogging by is passed by a car. The car, looking at the person jogging by, looks like that person's slower than anything, right? It's a frame of reference is all it is. And then, the plane flying up above looks down. Everybody seems like they're standing still, because it's just things are moving faster than the other. And that's the frame of reference. And that actually, it was in physics class where that idea of market regimes really hit me. And it was, okay, I just need a frame of reference here. Mm-hmm. I don't, if I can figure out what frame of reference gets me into that 80%, 50 to 80% win rate time and keeps me out of that 10, 20% win rate time, that's a big edge. So what I basically have come to is there's three directions that the markets move: up, down, sideways, bullish, neutral, bearish. And they do it in a volatile or a quiet fashion.
Right.
And a volatile fashion would be like I have categorized it by the daily change, the average of the daily change. So, for example, let's say NASDAQ's up 0.5%. That's a quiet day. Above 1.6%, that's a volatile day. And then below about 20.2% is a neutral day. And okay, so that's nice, but that's at the end of the day that you figure that, right?
Right.
So what we want to do is we want to average out the last 100 days of trading and see what the average is of all of those. And that'll give you a way to categorize it. So if it's going up and it's on average, not 100 of them, but the average of 100 is trading less than 1.5% or so, that's a bull quiet.
And that's how you define the regime over the average regime for that time period.
Yeah. And then, so now I have, okay, everything above. So if I have an average above 0.2 and below 1.5 over the course of 100 trading days, well, okay, now I understand. That's like having a calendar and a map. If I tell you, hey, Seth, meet me in Montana, that's great. You love Montana. Montana sounds like a blast. I need one key piece of information though. What month?
Right.
Because Montana, if it's January or July, those are two incredibly different things and have a major effect on every other decision. And so that market regime is like a calendar. It's just, the characteristic. If I said, hey, meet me in January in Montana, you're probably going to think to yourself, winter coat, snow boots, gloves, skis, things like that. The last thing you're not thinking mountain bike. You're not thinking swimming in the lake.
Yeah.
And so that basically you're saying, okay, I can see there's something that happens in here. And then you start getting characteristics. So much like the calendar, if you were to wake up and you didn't know where you were, what month was it, anything, you just woke up, walked outside, look at your watch, it was 3 p.m., the sun was going down, there was 3 feet of snow and it was freezing, you'd have a pretty good idea of what you were dealing with. You'd probably be in the winter in the northern region of the world, or south, pole or southern regions, like really far south. You actually don't need information. So now, instead of getting this fancy indicator to tell me we've been trading up 1.5%, I can look at the price and the direction and say, okay, this is it. And that gives me more characteristics. Now, the next thing that's really useful is understanding the underlying incentives of what you're trading. Like Bitcoin, for example, there's only 21 million and people aren't really selling it. So number go up. Right. Equity indices, their job is to get rid of the worst performers and bring the better performers in.
Right. Quarterly rebalances. Yeah.
And so what does that mean? That means it's always going to have the best looking people hanging out, and you're always going to think, so number go up. That's how it is. When it breaks and goes down, that's kind of a broken market. But 89% of the time over the last 70 years, the market has basically gone up.
Yeah.
And broken down by those different regimes. So if we just break down bullish regimes versus bearish regimes, it's about 89% of the time that it goes up. So right away, what you can think of is say, okay, is the most obvious thing in the world. I just need to focus on it going up. Right. I need to find strategies that work in this. I don't need to worry so much about that, because when it happens, it happens.
Do it the other way around for some reason. Do you find that they always focus on what are the negatives? What are my risks, as opposed to actually defining that they should be taking risks based on, as you were saying, the structure of the market over time, putting the best looking stocks, the best looking people. They gravitate, especially the newer novice investors, if you will. They're always focused on what are my risks? What about if the market goes down? Well, get the statistics for that. So yeah, absolutely.
1,000%. 1,000%. It's exactly it. If you don't have the first one, don't even worry about the second one. If you don't have that, it's the 80-20 rule. Like if you don't, it's obvious that 80% is in your favor. Yeah. Focus on that. Yeah. And
I'm sorry to interrupt you. You had 2 trades that you actually put on recently.
Let's get on them.
Okay, good stuff. I believe one was the diamonds, right? In this
Let's do it. That's an easy one.
Environment we are in. But I think diamonds and Apple, I believe. And
yeah, I think you guys picked up Apple this week too, yeah?
We did, yeah. Well, it's been a core holding of mine going back to 2020, but and I'm a bottoms up kind of guy and tops down. I littered myself over, as you were saying, it took me about 7 or 8 years to, find my process and weed out the things that were superfluous to actually understanding how the market works and simplification of it. But yeah, I look at, fundamentals and I say to myself, is Apple going to get it done? Has it gotten it done in the past? what's the valuation today versus the potential tomorrow? And yeah, absolutely. I think, long term, Apple will get you done. I'm not saying overweighted to, anybody or anything like that, but, that's a brand that's not going away. It's got a balance sheet that's not going away, and I look at those fundamentals, buybacks and dividends and just the earnings power, the market share. And I say to myself, I want to own Apple. So absolutely.
Yeah, I'm with you. I just bought a Mac Mini, and this thing with the new M1 chip, this thing is the most, as it should be, the most incredible computer I've ever had. Like every new computer should be that, right? Because that's how technology works.
Yeah.
It gets better. But it's just blown me away compared to this massive MacBook Pro that just runs circles around that Pro.
Yeah.
Like it's incredible. That's the thing about Apple is they, except for their laptops, maybe they're different now, but I've only been blown away by Apple machines. Any product that they have, they still continue to outperform my expectations. But so yeah, let's get into the diamonds. So I spent, and I think Seth, I said something in back about the bottom in 2020 bottom. I said the greatest trader in the world got long March 23rd.
Yep.
I got long April 5th. You have two of those people on this call, the one who got long March 23rd, and then the guy who waited till it was safe.
Our destinations are the same place, we're so it doesn't really matter.
Yeah. I'm rarely going to be the guy who's going to bottom tick or top tick anything. I'm going to look for the characteristics that are in my favor. And so looking at NASDAQ real quick to frame it, when I got long, the reason I got long is because I knew the characteristics of the market regimes that I'm interested in. And I wanted to be in those bullish market regimes. The best characteristic of a bull quiet regime is that the best looking sell setups anywhere, you're going to see them. They're going to come out of nowhere in a bull market. And every financial justice warrior, Sven himself, is going to come out and start screaming about everything. The market's going to end. It's Lehman tomorrow. It's everything. And then the next day, it doesn't do it.
Right.
And then you get the old dead cat bounce. This is just a first leg up and a second, or first leg down in a multi-leg thing. And it just keeps going up. And then you have a sell. You're like, oh, great. Finally, I'm going to add to my short. And so the bears keep shorting against knowledge. 80%, 90%, almost 90% of the time it's going up.
Providing extra fuel. Extra fuel.
They're the fuel.
The upticks.
Which is what your point on breadth or on volume, low volume rising is exactly what you want to see. That is quintessential bull quiet. That means it's going to resolve itself higher. And how does that happen? There's so many people who have cash to put to work on the sidelines. Shorts have to cover. And, you have a dollar cost average bid every first week of the trading month. You have so many things that are just built to go forward. And that's pretty much what happened. Now, to the NASDAQ, we pretty much did that all the way until we discovered that the end of August, we had broken out of the easy time and we moved to the high volatile time. So we hedged and got out of the way. And then we got long again and launched another campaign. So what got me into it's systematic, but you look for those characteristics. What got me into the Dow, the diamonds, was that when the sell-off happened 2 weeks ago, when the NASDAQ just went straight down, the Dow didn't. Dow didn't. It went down, but we're not talking like 11% or whatever it was.
Definitely.
It just by sitting there and not getting sold off. Because it hadn't gotten out in front of its skis either. It had stayed compared to NASDAQ, we hit new all-time highs in the Dow in November. I think that happened in June on the NASDAQ, summertime. So we're way behind there. So I'm not really like, oh, I'm Mr. Value guy. This thing way outperformed. I need to flip. But I certainly got a lot more confident after reading your State of the Market. So I went out, and then one of my key principles is getting into these. I like to trade deep out of the money calls on. I'm not going to take these swing positions like this unless there's 6 month to 2 year time horizon for me.
Right.
So what does that mean is I don't want to pay huge delta to get into something that, I'm buying $2 a call for that, is trading at like a 70 delta or something like that. I want to be down to where if we have a 5 or a 10% drop,
Right.
a little bit of small pain.
Right. Everybody
And
takes
then,
a drawdown.
Yeah, that'd be a little bit. But from $1.50 down to 10 cents versus, 20 cents down to 10 cents is more my game. So I'm looking for a price advantage, a price edge. I'm looking at the incentive of the diamonds. It's to go up, the Dow. I'm looking at underperformance, and then I'm using a simple measured move, which is the peak to the low, add that distance to the top, and that gives you a price target. So the price target on the Dow, the really easy price target is 352. We got in around 320. It's currently at 330 or so. So we got in earlier last week, I think. And then my real price target, the real measured move, making up for what happened, the COVID bottom, top to bottom measured move, gets us to 398. So it turns out that 360s, January 2022, 360 calls were at 15 delta or so. So at 352, that gives us 10 months or so to get there. We're already so
pretty good profit on that unrealized
a week.
Yeah.
And we have $22 to go. We've done $10 in about a week. So, and pretty much if you just look at the daily chart on diamonds, they've just really taken over, and they're in that bull quiet regime. So I'm really excited to see how today's trading is a great example. Thursday, March 18th, we're negative on the Dow at the moment. It's
up like almost 200 points on the day. Yeah,
it was a big one. And so what I'm interested is the reaction to the selling, because I want the bears to see it, get excited, Sven to send his tweets out, and then
he hasn't blocked you yet.
I probably has. Everybody like screenshots him and sends it out. I don't even know if I follow.
Yeah, I think I'm 2 years into my my blocked anniversary, if you will. So.
I'm just looking for I'm looking for weakness, and on weakness I add. That's my strategy. So this is first entry. So far so good. Ideally I want to add 10 or 15 times to this by the time we get to a profit taking move.
Well, let me throw a question out there. What, like you said, you want to see the bears, elevate. You want to see what they do with this. You ideally want to add on dips because nothing has really changed except for price. That's kind of how I look at it. Has anything changed in the macro? Has anything changed in the earnings outlook? So on and so forth. What would inhibit you from going forward with the action play? What would you look for that says, okay, wait, I originally was going to, add? Is there anything, identifiers that tell you, okay, hit the pause button or eject even possibly?
Yeah. So the real worrisome ones are like March of 2020. Mm-hmm. We know that first of all, when we get into the bull volatile regime, that's where overwhelmingly that is a requirement for a major market top.
Okay.
So it doesn't mean we're going to have a major market top. It just means that is a requirement. And you'll see that by multiple days above 1.5% change to the upside, usually. Gotcha. Another thing I see is the indicator I use, the SQN, goes into that. That's the actual quantitative formula, that the standard deviation of the 100 EMA or 100 MA square rooted. Simple chart. It's not hard. It just sounds, it's a couple
gotcha.
characters in Excel. But when that goes and sustains above 1.6 or 1.5, 1.6 for a period of time, that's a first indicator to me that it's a requirement for a major market top. It doesn't mean you get a major market
Right.
top. So it's not an if then. It's just like, okay, conditions have changed. We're not going to thaw in Montana just because it's March, and spring starting. There's other things that need to happen. But we're in spring, so theoretically we're going to start thawing. And then I have the next thing is a trend line parabola breakout or parabolic breakout. And we kind of just broke out of the parabolic move, but again, we're still under the bull volatile regime. So that's good. And then the last thing is if the monthly pivots R3, if there's a monthly close above R3, which pivots just 1, 2, 3 standard deviations of, whatever the month of trading. If you stack bull volatile, parabola, and a R3 close, actually, and also one last key characteristic is if you get a 10%, a typical entry into bull volatile, there's average 10% move higher from there. So it's higher risk, but that's where you start. That's where you start getting 2, 3, 4% multiple days straight up. So that would be for me to hedge, which I did on NASDAQ a couple of weeks ago because we met some of those requirements, not all three. And in August or the end of August, we met all three of those conditions. So August 30th, I believe I bought puts on the whole portfolio, and we ended up catching that whole 11% down move. So on the upside, that's where I would look to start locking in. Either I'm going to buy puts and hold my floor, and hopefully they'll expire worthless while we run to Dow 100,000 or whatever. But the other thing would be the downside flip, right? And you'd want to see like a day or two sustained big bar selling. So, multiple 3-5% moves. So, and then I want to see the react. Go ahead.
I think this was the fastest in history that the Dow has gone from 1,000 points, from 32,000 to 33,000. I think it was, I want to say 14, 15 trading days. We moved 1,000 points in the Dow, fastest in history. It's, some of the things that are taking place right now, you definitely have to, we had talked off camera a little bit, and we were talking about NFTs and all the different asset classes and all the different new market participants, if you will, and how that's kind of lending itself to this environment and, maybe even impeding, just identifying what's going on beneath the surface. But your system and your process really weeds out a lot of noise, which I think it lends itself really well. And all the back testing that you do is just phenomenal. With that, again, thank you for joining us, introducing you to the Finom Group audience, which is going to get to know you a lot better in the coming quarters.
Looking forward to it.
And hopefully we can do more of these state of the markets, maybe once a month again together, because I know you got your whole thing going on during the course of the week and the day. But definitely looking forward to the Dow, the diamonds, if you will, the Apple trade coming to fruition, and future trades that you got going on. One of the trades that we were actually looking at, Facebook. Technicals on Facebook look fantastic. Really has a nice had a nice break of that trend line, that downward sloping trend line. Had a really nice upward thrust above the neckline of an inverse head and shoulder. I mean, how many formations can we define here that Facebook is, doing well? And it's outperforming its fan mag brethren as well lately. But I'm looking at that one pretty closely, possibly introducing as a longer term trade for Finom Group, and I'm sure you'll be looking at that now with some deep out of the money calls as well. So again, thank you for joining us this week, Chris, and thank you to our audience. I know we went a little bit long in the tooth here this week, but we had a lot to cover. There's a lot of noise in the market now, and we're trying to weed that out. One of the things that I always preach is stick to your game plan. If nothing has really changed but the price, then there's nothing wrong with your game plan. Review your process, The more you build your resources, have a team around you, a feedback system, the better that you're going to do. Don't be a lone wolf trader, folks. That kind of trader just tends to weed themselves out within the first 2 years of trading. So with that, thank you for joining us, everybody, on this week's State of the Market. Trade safely.